Hi guys, so the next chapter that we are looking at is called Audit of Banks, and in this chapter we will be discussing about what is the legal framework of a bank and how is it going to work on. So it's a very basic simple chapter. Lots of topics are something that we've already seen in CA Inter, so now we will be exclusively looking at some of those topics with respect to the legal framework as to what the bank is and how we are going to deal with the audit of accounts, and then how to conduct the audit. We will be dealing with that as well, and we will also be dealing with compliance with CRR, SLR, the cash reserve ratios and statutory liquidity ratio, verification of assets and liabilities, both we are seeing. Concurrent audit, small concept towards the end. So these two have a lot of role to play. So we are going to talk about those two in greater detail, and then we will also towards the end talk about some of the prudential norms that are established by RBI, and these two long discussion on those also. Okay, let's go on. Let's start with the first part, looking at what are the various laws and regulations that are applicable to the bank. Now there are so many laws and regulations that are applicable to the bank. So if you can take a list, or take a look at all those laws and regulations that are applicable, you can see starting from the Banking Regulation Act, you can see there, which is the first one. So many laws: Banking Regulation Act, SBI Act, Companies Act, SBI Subsidiaries Act, Banking Companies Acquisition and Transfer of Undertakings, RRBs Act, Banking Companies Acquisition and Transfer, IT Act 2000, Prevention of Money Laundering Act, PMLA, very important, and Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, Credit Information Companies Regulation Act, and Payment and Settlement Systems. So all these, besides the above enactments, the provisions of RBI Act, obviously that is a guiding factor, right? Provisions of RBI Act are also applicable. The Act gives wide powers to RBI to give directions of bank, which have also a considerable effect on the functioning of the banks. That's what it is all about in this first. So if you're looking at the very first part of what this story is and how it goes, so let's start dealing with appointment of auditor. Now it's a very important topic. There could be a question on this from this topic in MCQs. There could always be a question coming on this indirectly, so there is always a possibility of this question arising. Banking company, any banking company, normally it is appointed by the shareholders in the AGM with prior approval of RBI, and they're appointed. Then talk about nationalized bank. The auditor of a nationalized bank is appointed by the bank concerned, that is by the board of its directors, again with prior approval of the RBI. SBI is appointed by CAG of India in consultation with central government. Subsidiaries of SBI are appointed by SBI. And then also to know another point, RRBs, appointment by the bank concerned, which is again by or through their board. So these are all the points that one needs to consider in terms of appointment of auditor. And this, if any of you watching this are the students of CA Inter, there also we have made this kind of a table to just highlight who becomes the auditor of which bank. It's a very important and a very basic topic as well. Going by that, remuneration of the auditor shall be in accordance with provisions of section 142, which talks about remuneration of auditors, the same section that is providing here also. That is by company in general meeting or in such manner as may be prescribed in the general meeting, they may determine. The remuneration of the auditors of nationalized banks, and SBI is to be fixed by RBI in consultation with the central government. So what are the powers of the auditor? If you're considering that, what are the powers of the auditor? The auditor of a banking company or of a nationalized bank, SBI, and a subsidiary of SBI or an RRB has the same powers. They have the same powers as those of the company auditor in the matter of access to books of accounts. So right to obtain information, explanation, right to access books of accounts, documents, vouchers, all those are there even for the powers of the auditor normally. Then talk about auditor's report. you remember this auditor's report along with LFAR, long form audit report. So in case of a nationalized bank, the auditor is required to make a report to central government, in which, what are you talking about? Like normally we give a true and fair view of the financial statements, right? What are we talking about here? Whether in his opinion, the balance sheet and P&L, that is balance sheet is full and fair balance sheet containing all necessary particulars. Does it contain all necessary particulars and is properly drawn up so as to exhibit a true and fair view of the affairs of the bank. So it's just again sticking to the bottom line in audit. Are the financial statements showing a true and fair view? That's the question. Then in case he had called for any explanation, or information, whether it has been given and whether things are satisfactory. That's what you're trying to talk about, whether things are satisfactory in this regard. Whether or not transactions of the bank have been, within the powers, right? Ultra wires and intra wires. Ultra wires is beyond the powers. So all I'm saying is it should not be ultra wires and it should be intra wires within the powers. And whether the returns received from the offices and branches. You remember seeing all this in section 143? If the branch is not being audited, you got to send a copy of the return, okay, so that it has been audited. So whether the returns have been received from the branches, whether the profit and loss account shows a true balance of profit and loss, whether the P&L account shows a true balance of the profit or loss for the period covered by such account, and any other matter which he considers to be brought to the notice of the central government. So whatever is the matter that he is willing to bring up to the knowledge of central government, that. And as indicated, no surprises, wherein format of audit report, if you speak about that, the auditor should also ensure that the audit report issued by them complies the requirements of standard number 700. The auditor should also ensure that the audit report issued by them complies with the requirements of standard number 700, which is about forming an opinion and reporting on financial statements. And if there is any modification EOM paragraph, so you go by the same reporting requirements. Okay, what are the same reporting requirements? SA 700, 705, 706, 3 standards. The auditor should ensure that audit report issued by them complies the requirements of standard number 700, 705 and 706. And as per the requirements cast through Rule 11 of the Companies Audit and Auditors Rules 2014, the auditor's report shall also include their views and comments on the following matters. Like 3 matters are there exclusively prescribed. What are those? That whether the bank has disclosed the impact of any pending litigations, material foreseeable losses with respect to any derivative contracts, and whether there are any delays in transfers to IEPF. And also there is point number 4 added up, whether they have dealt with any specified banknote. But this being a bank, I think if you're reporting on these 3 points, it's good to go. Then there is also a report that is supposed to be made, which is called LFAR, long form audit report. Lots of points are there for us to report. And as you know, CARO is not applicable to a banking company. That is why LFAR, CARO 2016 is not applicable to a banking company. When CARO 2016 is not applicable to a banking company, besides the audit report, as per the statutory requirements, the terms of appointment of auditors of a public sector bank, private sector bank and foreign banks as well as their branches require the auditors to also furnish a long form audit report. What is it? To furnish a long form audit report. The matters which the banks require their auditors to deal with, in the long form audit report have been specified by the RBI. So RBI gives a clear description of what is the content that is supposed to be put in the LFAR. So that is a basic idea of what are the various laws that are applicable to the banks, what is the audit reporting requirement, and what are the standards that is supposed to follow, and what an LFAR is. And towards the end, the last part of dealing with reporting is reporting to RBI. Obviously, RBI being the custodian of all the banks. If an accounting professional, whether in course of internal or external audit or in the process of institutional audit, finds anything susceptible to a fraud. See, in banks, public money is involved. In banks, public money is involved. And if there is anything that you believe is susceptible to a fraud, I think your immediate duty is to report that to the RBI. Or he smells any foul play, in any transaction, he should refer the matter to the regulator. Refer the matter to whom? To the regulator. Any deliberate failure on part of the auditor should render himself liable for an action, be rendering himself liable for a action. So that is what RBI circular is. If member of the institute suo moto, that is on his own, if member of the institute on his own discloses any information regarding actual or possible fraud or foul play to RBI, the member would be liable for disciplinary action. On his own, you should not talk about anything. But if you do that in good faith, wherein you believe that something might have happened like that, right, where there is a belief in good faith. However, a member is not held guilty under the said clause if the client explicitly permits the auditor to do so, to give any information to third party. You know this, client is permitted, then there is no problem. And as you know, in this beginning of this chapter, you saw the legal framework of the bank. So many laws and regulations are applicable to the bank, right? Now, when so many laws and regulations are applicable to the bank, it is a duty of the auditor to see whether the bank has in fact complied with all those laws and regulations. So standard number 240, which talks about 250, which talks about compliance of laws and regulations and audit of financial statements, and 240, which is on fraud. This is on laws and regulations and this is on fraud. You got to comply on both these as well. Standard number 240, auditor's responsibility relating to fraud and audit of financial statements, states that an auditor conducting an audit in accordance with standards is responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatement. They're free from material misstatement, whether caused by fraud or error. It must be noted that auditor is not expected. To look into each and every transaction. It must be noted that auditor is not expected, just like any other auditor, okay? Auditor is not expected to look into each and every transaction, but to evaluate the system as a whole. It must be noted that auditor is not expected to look into each and every transaction, but to evaluate the system as a whole. Therefore, if the auditor, while performing his normal duties, comes across any instance, he should report the matter to RBI. In addition to the chairman, managing director and CEO of the concerned bank. So apart from telling them, you know this, normally also we inform the TCWG, right? So that is exactly why here also you're supposed to inform to RBI, which is playing a role of the governance role. Okay, clear all these points. Let's now move on. Here we are talking about how to go about conducting an audit. Again, I don't think the real problem is there. Stand number 210, okay, on understanding the terms of audit engagement, SA 315 for the bank risk assessment and understanding of the bank's environment is execute that part of audit. Then the 700 series where you are actually talking about reporting. So let's just have a quick glance on what are the areas. So look at some initial considerations. As you see, some initial considerations right here. Acceptance and continuance, declaration of indebtedness, you can't be indebted, right? And internal assignments in banks by statutory auditors, have you held any? Terms of audit engagement, communication with the previous auditor, it's an ethical requirement. And establish an engagement team. Now all this, as I said, is conducted as part of standard number 210, which are part of your initial considerations. Then understanding, now it's again 315 part 1, understanding the bank and its environment, including internal control. Understand bank's accounting process, have an understanding of the bank's accounting process, and understanding the risk management process also. Understanding the risk management process, which is all part of 315, straight and clear. You got to do all of that. Then risk assessment. Now you know what risk assessment is all about. It is 315, identifying and assessing the risk of material misstatement. Then 240, including fraud. And now we also talk about money laundering because this is bank. And risk associated with outsourcing of activities. Remember dealing with chapter number 402 on service organizations. When you, if at all you have outsourced any activities, that also have to be taken into consideration. Then most importantly, if you simply plan, it's not going to take you anywhere, it's not enough at all. Then what are you supposed to do? You're supposed to make engagement team discussions, prepare responses to the assessed risk, establish the overall audit strategy. Then what you're supposed to do and how you're supposed to deal with, establish the overall audit strategy. Audit planning memorandum, prepare an audit planning memorandum as to what it is and how it is, an audit planning memorandum. Determine audit materiality, essay 320 and essay 570 is on considering going concern. So all these points are supposed to be taken care of. And finally the 7 series which talks about reporting. Now you're supposed to give an independent auditor's report. You're not supposed to just give an independent auditor's report alone. You're also supposed to give a LFAR, long form audit report, and report any other matters the bank, regulator or the government, whatever as you required. Now you saw that whatever is required you got to take into consideration for that and report the matters to the respective people. Okay, and going further, we're now going to talk about something that is okay, 143 subsection 12 to 15. I am not discussing the entire section again, but all I am saying is duty to report on frauds is still there for the auditor. Okay, and that's the whole issue here. So what we are talking about is 143 subsection 12 to 15. Subsection 15 is as per section 143(12) of the Companies Act. If the auditor of the company in the course of the performance of his duties as an auditor has sufficient reasons to believe that an offence involving fraud is being or has been committed against the company by officers or employees of the company, he shall immediately report the matter to central government. Within 60 days of the knowledge and the following prescribed procedure. Right, so you know this procedure, that's why we are not discussing this. 143(12) to 15, exactly what we already discussed in company audit. So entire procedure, if the fraud, you know, right, 1 crore and above individually goes to central government, below that goes to the board. All I am saying is 143(12) to 15 is absolutely applicable even in case of banks. Okay, picking up from that and going further is two very important topics which I believe can always be asked, and as a normal CA student also, anybody who's having awareness of this profession, they should be aware of these two terms, because quite often you see that RBI has changed the CRR, RBI has changed the SLR. Now you can't be ignorant of the fact as to what is CRR and SLR, right? So let us get educated about those two terms. Now banking companies and other scheduled banks, banking companies and other scheduled banks are required to maintain certain minimum cash reserve. Certain minimum cash reserve. That's the whole point. Banking companies and other scheduled banks are required to maintain a certain minimum cash reserve. While the requirement for maintaining cash reserve by companies is contained in the Banking Regulation Act, corresponding requirement is scheduled banks is also there in the RBI Act 1934. Now, how much is a CRR? What is it? The RBI from time to time reviews the evolving liquidity situation. Now, this is totally based on the economy and accordingly decides the rate of CRR required to be maintained by scheduled commercial banks. Now, obviously as an auditor it is your duty to see. You can find it on the RBI's website. Now I am not giving you numbers here because I don't want to confuse you, because after I do this video and there is a change then unnecessary confusion will be there. That's why I'm not giving any numbers. You can, whenever you're watching this video right now, you can go onto the RBI website to see what is the CRR anytime, right? As you understand, because now if I tell and write a number at today's CRR, you're watching it a little later, and then there are changes. I don't want to confuse you and all that. So you can go and find both these numbers on the RBI's website. So minimum cash reserve that banks have to maintain as prescribed by RBI from time to time, that's called the cash reserve ratio. Now, see, it depends, like in terms of inflation, where already too much money is chasing the bank, increases the bank rate, so that banks start giving more interest rates. People are encouraged to make deposits and all. Vice versa, when the flow is less, they want liquidity. So you can decide on too liquid, not liquid. All this increase and decrease of CRR is totally the discretion of RBI, depending on the situation in the economy. Then SLR. SLR is basically liquidity ratio, statutory liquidity ratio requirements. The Reserve Bank of India requires statutory central audit of bank to verify the SLR requirements on 12 odd dates in different months of financial year, which are not being Fridays. So barring Fridays, you take 12 different dates in 12 months and check that. The resultant report is to be sent to the top management of the bank and to RBI. One copy of that. The report of statutory auditors, in relation to compliance with SLR requirements have to cover two aspects. Correctness of the compilation of DTL. DTL stands for demand and time liabilities. I hope you know this, because you also did banking company accounts back in CA Inter, and maintenance of liquid assets. Now these two are the requirements that are to be specified, that are specified by RBI and that are to be checked by the auditor to make sure whether the entity is following that compliance or not. Okay. So guys, those are the two basic topics as to what are the laws and regulations that are applicable to, and what is that we'll basically do with those laws and regulations in the audit, plus audit approach. What are you following? Now let's discuss the entire approach and procedure in clear detail, and then we will get to verifying assets and liabilities in detail. Now see, it is impossible to check each and every transaction in the bank because you know what is the volume of those transactions. Having said that, sampling is one of the golden techniques that we as auditors always use, right? So on a test basis, examine on a test basis the consolidations regarding demand and time liabilities position. Examine on a test basis the consolidations regarding demand and time liabilities positions prepared by the bank with reference to the related returns received from branches. With reference to related returns received from the branches. Whether valuation of securities done by the bank is in accordance with the guidelines prescribed by RBI, are they in line with the guidelines prescribed by RBI? And examine the following things are excluded from liabilities. Okay, you see here these four are not supposed to be included as part of liabilities because they are not liabilities. You will know why. Recoveries from borrowers in respect of debts. Recoveries from the borrowers in respect of debts considered bad and doubtful. Amounts received in Indian currency against import bills and held in sundry deposits. Amounts received in Indian currency against import bills and held in sundry deposits pending receipts of final rates. Unadjusted deposits or balances lying in linked branches for agency. Business like dividend warrants, interest warrants, refund of application, etc. In respect of shares or debentures, to the extent of payment made by other branches, but not adjusted by the link branches. Margins held and kept in sundry deposits for funded facilities. Margins are certain money that you hold back. Now the question is, debts considered bad and doubtful, right? Indian currency that you are receiving against the import bills, shares and debentures to the extent payment made by other branches not adjusted, and all these are not supposed to be classified as liabilities because they are not. You can see them very clearly. Similarly, specifically examine two things: net credit balance in branch adjustment accounts and interest on deposit as at the end of the firm, half year reversed in the beginning of the next year half. See, banks have this practice of charging the interest pertaining to that, because some banks have the practice of giving it in September and March. Some banks, they give quarterly. So it all depends, like what was charged. Interest on deposit as at the end of the firm half year, that is by 30th September, reverse the beginning of the next year half, right? So from there to there, you're taking 1 year. What is that specifically you have to examine, and they have to be included in the liabilities, because see, this is like you don't have to pay it now, but you have to anyway pay it, right? Test check the relevant records. Test check the relevant records maintained by the bank in respect of investments to verify. Now, one more important point is that bank, whatever money the bank gets in form of deposits and all that, RBI has strict guidelines on where that money can be used and applied. Where that money can be used and applied. They have strict guidelines. Now, that exactly is what is something that we have to take care of in seeing whether the respective guidelines have been followed or not. While reporting on compliance with SLR requirements, the auditor should specify the number of unaudited branches. While reporting on compliance with SLR requirements, the auditor should specify the number of unaudited branches and state that he has relied on returns received. From the unaudited branches in forming his opinion. Okay. He has what? While reporting on compliance with SLR requirements, the auditor should specify the number of unaudited branches and state that he has relied on returns, because when you have not audited, this is like using the work of other auditors and returns received from those which are unaudited. If at all the branch is audited, right, then you can follow standard number 600, because you can rely or use the work of another auditor. But they are telling that it's unaudited. Then you have to mention where that unaudited portion was actually meant from. Then, okay, let's get to this topic, guys. I hope we are not going to spend more of the time, because many of these assets and liabilities, they're quite simple. But then, if at all you are talking about what these major assets are, we're talking about 4: cash, balance with RBI. You got to obviously the direct confirmation from the RBI you can get. Balance with other banks. One bank will put us money, and money at call and short notice. You know how to present all these when it comes to the presentation aspect, because you already did problems in CA Inter Advanced Accounting. But right now let's talk about how do we deal with this. So going by that logic, first let's pick up the first item, cash. You know what cash? How do you go by cash? Carry out physical verification of cash as close to the balance sheet date as possible. And the cash balance as physically verified should be tallied with the book balance. No big deal. So I don't want to waste much of a time on basic things. Let's check the most important ones going by that. Balance with RBI. The applicable to branches having an account with RBI. Check the ledger balances and bank confirmation certificate and reconciliation. You can get a direct confirmation from the RBI, and pay special attention to cash transactions remaining unresponded, revenue items requiring adjustments or write-offs, old outstanding balances remaining unexplained or unadjusted for more than 1 year, if at all anything between you and RBI. And obtain a written explanation from the management as to the reasons for old outstanding transactions in bank reconciliation statements remaining unexplained and unadjusted for more than 1 year. Checks issued but not presented, cleared, whatever are the stories that you might as well want to take into consideration. Then balance with banks other than RBI, other banks if there is any. Examine that no debit for charges or credit for interest. This is just about keeping money with other banks. So examine that no debit for charges or credit for interest is outstanding, and all items which are supposed to be taken into consideration as revenue are taken. No check sent or received in clearing is outstanding. Ensure that all bills are outstanding, checks sent for collection and outstanding as of the closing date have been credited subsequently. Balance with banks outside India should be also verified in the manner above. Foreign banks, if you're keeping any nostro accounts, these balances should be converted into Indian currency as the exchange rate prevailing, which is again available on the website of the RBI. You can take the exchange rate of various currencies from the RBI website and cross check them accordingly. So that is the basic point that we have been looking at. Then going further to the last point is money at call and short notice. Examine whether there is a proper authorization. Examine whether there is a proper authorization, be it general or specific, for lending money at call or short notice. Call loans should be verified with the certificates of borrowers and call loan receipt held by the bank. So you have given a loan which is, it is repayable at a call. So basically you have to make sure that you show the certificate to the auditor saying that we have given so many loans that are repayable on call. Examine whether their aggregate balances, examine whether the aggregate balances comprising of this item as shown in the relevant register tally with the control accounts as per the general ledger. They should tally with the control accounts as per general ledger. Examine any subsequent repayments received from borrowing banks. Examine subsequent repayments received from borrowing banks to verify the amount shown under this head as at the year end. And it may be noted that call loans made by the bank cannot be netted off against call loans received. You have to show them both separately on both sides. You gave any call loans and you received some call loans doesn't mean that you can net off them and show only money is at call and short notice so much. Calls to be what you got, and calls received and calls made short notice, you got to show them separately on either sides. Now let's talk about the next item, which is called investments. How do you deal with investments? Come on, let's see this. Internal control evaluation investment policy. That's the first thing that we do. Normally also, generally when we check all these items, we do check the internal control, if you remember, right? So review the investment policy. Review the investment policy of the bank to ascertain that the policy conforms, that means sticks to or matches in all material respects to the RBI's guidelines as well as to any statutory provisions applicable to the bank. And one person should not be a complete authority for buying an investment and selling it off. Segregation of duties is a great internal control. Check the segregation of duties. Check the segregation of duties within the bank staff in terms of executing trades, settlement, and monitoring of such trades. Check the segregation of duties within the bank staff in terms of executing trades, settlement, and monitoring of such trades and accounting of the same. They are termed as front office, middle office, and back office functions. For it's called the trading room. If at all you're a student of CA Inter and you have done EIS, wherein you have seen core banking systems, all this particular piece of how their operations, they are explained in that chapter. Now reconciliation. As an auditor, what investments were bought during the year, sold during the year, what were bought, what were retained, what were there in the opening, sold during this year, all of that has to be a quick reconciliation of all of that, right? So examination of reconciliations to the investment account. Physically verify the securities. Examine the reconciliation of investment account. Physically verify the securities. Now it is obviously it's a basic point that you are supposed to deal with in terms of verifying what exactly is the investment balance. So what is the investment balance, how and what it is also something that you will have to take into consideration. Okay, so and obtain confirmations from counterparty banks, that is a third party banks. Okay, so then as a matter of fact, we also have to discuss about The bank receipts involved. Okay, so let's see this. Examine the reconciliation of the investment account, physically verify the securities on hand, obtain confirmations from counterparty banks for bank receipts, right, or bills receivable issued by such banks on hand, and obtaining special general ledger. Confirmation is subsidiary general ledgers, sorry, not special, subsidiary general ledgers with the public debt office, PDOs, public debt office, and examine the control of reconciliation of bills receivable issued by the bank. All these are some of the points that we need to take into consideration. Okay. An examination of documents. What will you check? Ascertain whether investments made by the bank. Ascertain whether the investments made by the bank are within its authority. Ensure that any covenants. Ensure that any covenants or conditions which restrict, qualify or abridge the right of ownership and disposal of investments. That now, is there anything that stops you from selling that, or any restricted ownership have been complied with the bank? The acquisition or disposal of investments, should be verified with reference to the broker's contract note, bill of costs, receipts, and other similar evidences. So you got to cross check this investments in that particular manner. Right, let's talk about details. Now, physical verification, take each investment and you can have an understanding of the document. Verify the investment scripts physically, underline. Verify investment script physically. Verify the investment scripts physically at the close of the business on the date of the balance sheet. In respect of scriptless dealings, that is through demat form and all that, scriptless dealings, when there is any scriptless dealings, investments through over the counter, OTC stands for over the counter exchange, the auditor should verify the interim and other acknowledgements issued by the dealers. Now, so everything is happening demat, so you will have a proof for all of these. If certain securities are held in a name of nominees, the auditor should examine whether there are proper transfer deeds, signed by the holders of an undertaking from them, that they hold the securities, on behalf of the bank, Examine whether the method of accounting followed by the bank, in respect of investments, including their year-end valuation, is appropriate, whether that is perfect or not. And examine whether the investments have been properly classified. Into three categories. At the time of acquisition, based on such intention as evidenced by the decision of competent authority. And the ALCO stands for Asset Liability Committee or Investment Committee. Asset Liability Committee. Examine compliance by the bank with guidelines of RBI as per the valuation of investments. Examine whether the income from investments is properly accounted for. This aspect assumes special importance. In cases where the banks has opted for receipt of income through the electronic or online medium. Anybody has obtained anything electronic or online, this is something to be taken care of. Examine whether the P&L account, profit or loss on sale of investment, have been computed properly. And verify that there is a proper system of recording and maintenance, the TDS certificates received by the bank. Tax deducted by others on the bank, that TDS certificate. Now you can see Form 26A is online. You don't have to really worry about. Now, let's talk about the next part. Dealings in securities on behalf of others. Examine whether prior approval for carrying out such dealings have been obtained. Details. Examine whether banks' income from such activities has been recorded and is fairly stated in the bank's financial statements. Examine whether banks' income from such activities has been recorded and is fairly stated in the bank's financial statements. Consider whether the bank has any material undisclosed liability. Consider whether the bank has any material undisclosed liability from a breach of its fiduciary duties, that is what is as per the law, including safekeeping of assets if they have broken any laws or regulations. Special purpose certificates relating to investments, if there are any, right? Examine whether the bank is maintaining separate accounts for the investments made by it or on their own investment account. On PMS stands for Portfolio Management Services. Portfolio Management Services. Lot of companies are there which are offering portfolio management services account. A PMS client's account. Now PMS clients see big numbers, 25 lakhs, 30 lakhs, 40 lakhs in the amount. Then they go for portfolio management services. So that examine whether the bank is maintaining separate accounts for the investments made by it on their own investment account, on PMS clients account, and on behalf of other constituents, and examine whether the shifting of investments from available for sale to held to maturity. With little later we will see three types of classifications in security. HTM, that is held till maturity. AFS, available for sale, right? So held to maturity means till the time it is going to mature, you're going to hold it. Then there's one thing called held for resale. Like the very purpose of buying it is to sell and make a profit. Don't worry, we're going to see all that little later. Examine the shifting of investments from or available from sale held to maturity is duly approved by the board of directors of the bank. Have they approved it and whether it has gone right? Then talking about advances. Now very important, you made advances. When you made advances, it is one of the most important things that anybody can do. And I'm pretty sure if most of you watching this have done bank audits, all of what I'm talking about except for a few things are new. But otherwise, I believe you would have done all this. For examination of advances process, first evaluate the internal controls over advances. Anybody and everybody should not be able to sanction of advances, right? They're restricted. These are restricted. Absolutely, powers are to be taken care of. So examine the loan documentation. Examine the validity of recorded amounts. Examine the existence, enforceability and valuation of security. Examine the existence, enforceability and valuation of security. Ensure compliance with terms of sanction. And end use of funds. Ensure compliance with terms of sanction and end use of funds. Ensure compliance with loan policy. Of the bank. Ensure compliance with what? Loan policy of the bank, as well as RBI norms, including appropriate classification and provisioning. Review the operation of these accounts. So what is it and all of what it is? You review the operation of those accounts. Now, see, these are all two parts to the story. If you look at how we are checking advances in the past, we talk about advances. We are going to check them by performing compliance procedures. When you say compliance procedures, a test of internal control and understanding this is what you see. Now in the next part, we are going to talk about substantive procedures. What are these various substantive procedures that we are talking about, and how the dealing is also something that we are supposed to take into consideration. Check that. Substantive audit procedures. When you say substantive audit procedures, check the amount included in balance sheet. Check the amounts included in balance sheet in respect of advances which are outstanding as of the date of balance sheet. Check that advances represent an amount due to the bank. Check that advances represent an amount due to the bank. Verify that amounts due to the bank are appropriately supported by loan documents and other documents as applicable to the nature of advances. Any unrecorded advances, that is very rare nowadays because all of this is done through core banking system. However, Check that stated basis of valuation. Check that the stated basis of valuation of advances is appropriate and properly applied, and that recoverability of advance is recognized in their valuation. Verify that advances are disclosed, classified and described in accordance with recognized accounting policies. Check appropriate provisions with respect to compliance with RBI norms, accounting standards and generally accepted principles. And examine all large advances while other advances may be examined on a sample basis. All large advances. Remember monetary unit or weighted value sampling. You do that. Examine all large advances while other advances may be examined on a sample basis. Verify completeness and accuracy of interest being charged. Verify the completeness and accuracy. Normal assertions. Then recoverability, review periodic statements submitted by borrowers, just to see the recovery capability to the extent of terms and conditions. Check their financial statements to all big advances made by bank. See, if tomorrow they turn insolvent, bank is going to lose the money. So you made an advance, see what is their financial position by checking the financial statement of the borrowers. Review reports on inspection of security. So you remember we did discuss about securities in the past. See, whenever we take a collateral security, the value of the collateral security, now you took that as a collateral, but after you took that as collateral, if the value is falling down, then there is nothing that you will recover later. So therefore, it's a very important thing that you might want to do this. Review auditors reports in case of borrowers who are enjoying credit limits of rupees 10 lakh or above for working capital from the bank system. So a lot of businesses, they enjoy 10 lakhs or more of the overdraft. For that, you see the audit reports in case of borrowers enjoying aggregate credit limits in various places for more than that. Okay, so that basically is the first part of our discussion. That's what we're going to talk about, wherein what are advances, and this entire thing that we discussed is all about verification of liabilities. Now in the next part, we will be discussing about fixed assets and verification of all of that, and then classification of investments into the three parts and prudential norms. So I will see you in the next part with all those.